This is the tkal earnings recap, number 001. For week of August 10th, 6 deep dives went up on tkal this week, and they told one story. Here it is. 6 deep dives, 6 strong top lines, and not one of them was argued on demand. Every fight this week happened below the revenue line, on margin, or on who funds the build. The neoclouds grew, and someone else funded it. CoreWeave grew revenue 112% to $2.575B, and grew net interest expense 140% to $640. Depreciation of 1.393B and that interest bill turned 1.510B of adjusted EBITDA into a $626 million net loss. Nebius inflected a positive adjusted EBITDA of $236.2 matters on 41% margin, then reported 2.2146B of operating cash flow against a $190.4 matters net loss. Roughly 197 buys of that was deferred revenue, and 1.187B was collecting receivables. The cash came from customers and creditors, not from the business. CoreWeave's balance sheet is compounding faster than the revenue it funds. Nebius's cash came from its customers. The margin line is where the tape did its arguing. Cisco beat and raised. Revenue of 17.3B up 18%. Non-GAAP EPS of 1.22 against a street near 1.17, 9.3B of hyperscaler AI orders for the year, product orders up 35%. The stock sold off after hours. Non-GAAP gross margin fell 210 basis points to 6.3%, and product margin fell 270 to 64.8%, guided to 65 to 66% next quarter. Supermicro ran the mirror image. GAAP gross margin doubled to 17.5% from 9.5%, explained by one word, mix, and then capitalized into a fiscal 27 guide of 65.72B against a street near 54B. One company was marked down for a margin it lost. The other asked to be marked up for a margin it has not yet held twice. Where the cycle actually converted. Silicon Motion was the week's clean print. Revenue up 127% to 451.0. Non-GAAP gross margin 50.2%, and operating margin nearly doubling to 23.1% from 12.8%, guided up again to 27.5 toward 28.5%. That is operating leverage arriving in the P&L rather than the roadmap. Applied Materials printed records across revenue at $9.115B, non-GAAP operating margin at 34.0%, EPS at $3.50, and a 13th straight quarter of gross margin expansion, and still sold off after hours on a stock that had already run hard. Applied's margin held. What repriced was the base underneath it, with DRAM at 26% of systems and China down to roughly 28% of revenue. Here's the call. The dividing line across all 6 prints is who absorbs the cost of the AI build. Where the customer or the creditor absorbs it, the equity got marked down this week. Where the vendor kept its own margin while selling into the same build, it got paid. Watch the next financing spread and the next gross margin print, not the next backlog number. Now, the board. CoreWeave. Revenue, plus 1% versus interest expense, plus 140%. 626 million net loss. Nebius, first positive AGG. EBITDA at 41%. The 225B OCF was working capital Supermicro, gross margin 9.5% to 17.5%, explained as mix, then guided up Silicon Motion, revenue, Plowissance 127%, operating margin 12.8% to 23.1%, guided higher. Cisco, beat and raised, sold off, total gross margin, 210 BPS Applied Materials. Records on every line, DRAM to 26% of systems, China to 28%. What to watch next? On CoreWeave's next financing. The spread on the next raise decides the year, not the backlog. A cheaper print falsifies the balance sheet short read. A wider one confirms it. On Supermicro's next quarterly margin. 17.5% was explained by mix, which is the softest thing a hardware vendor can ask you to capitalize. One more quarter near it, and the explanation stops mattering. On Cisco's Q1 fiscal 27 gross margin. Management already guided 65-66%, below the 66.3% just printed. If that band holds, the supercycle is real and structurally lower quality revenue. That's the week. Every one of these prints has a full written deep dive, every figure sourced at tkal.news/earnings. Not investment advice,